The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. Investing involves risk, including loss of principal. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Advisory services offered through VestGen Advisors LLC. People of Chicago, you're tuned in to In the Know Radio. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. And today he's going to teach you what you need to know. So get ready to learn something that could change your life. It's your host, Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. His phone lines are always open at 833-964-PLAN. Or go to GetRetiredStayRetired.com. Now, here's Craig.
So what about new administration, new year, new laws? In case you didn't know, President Biden signed that Social Security Fairness Act just on the 5th of January. What does it mean for you? What does it mean for your parents? What does it mean for your family? We're going to break that down in a bit. Hey, Wall Street Hope, Wall Street Hype 2025. Is it fact? Is it fiction? We're going to talk about what you need to know to protect and grow your assets in a little bit. Trump tax plan, inauguration. It's right around the corner. What's going to come through in 2025 that can put money in your pocket? What might take some money away? And what are the strategies you need to be successful? All that and more. We come to you every week for one purpose. We want to help you get retired and stay retired. We don't want you to survive retirement. I want to make sure that you thrive in retirement, and that's going to take a plan. Specifically, it takes a plan supported by a family office, and that's what we're about at VestGen Wealth Partners. It's a family office for everyone. It's making sure that you have an integrated planning team for your investments, your cash flow modeling, your retiree health care, your taxes, your estate plan, the entire kit and caboodle, end to end. Family office for everyone. Connect with us, 833-964-PLAN. That's 833-964-PLAN. Go to the website, GetRetiredStayRetired.com. Well, listen, nearly 3 million people are going to see their Social Security benefits increase due to new changes signed into law by outgoing President Biden. What's it called? The Social Security Fairness Act. Now, this Social Security Fairness Act essentially undid 40-some years of legislation that had been in the books, legislation that started way back in 1977 and 1980. So essentially, what does this mean? Well, the Social Security Fairness Act, it's fair to 3 million. It might be unfair to the rest. But what it's doing is it's eliminating the windfall elimination provision and taking away the GPO, the government pension offset. And those were essentially systems that were in play that affected those who had non-covered pensions. What's a non-covered pension? It's someone who works for an employer who accrues a pension but is not paying in to Social Security. So this doesn't affect all, but it affects some public service workers, firefighters, police officers in Illinois. Think TRS, the Teachers Retirement System, CPS, the Chicago Public School System, SERS, State University Retirement System, just to name a few. So the real question is going to be, wait a second, 3 million people are about to see a bump to their Social Security? Well, when are they going to see it? Like all things government work, we have no idea. We'll find it at some point in the future, because whenever you undo 40-some years of legislation, it takes time to actually get this thing administered. How much time? We don't know. It's not yet on the website. I think it's going to take a couple of months. How are people going to get paid? Well, here's the big one. When President Biden signed this into office, it was retroactive to January 1st. You thought I was going to say 2025. We're talking about the Social Security Fairness Act that just got passed. It was signed retroactive to January 1st, 2024. So what does that mean? people are going to be entitled to what I consider to be a windfall lump sum. People are literally going to get a lump sum check going all the way back to Jan 1 of 2024 up until the program starts at some point in time in 2025. In addition to that lump sum check, people can anticipate getting a bump in their monthly pay. So I know what you're thinking. How much more are 3 million people going to get a bump up? Well, first, there's a price tag. This sucker is going to cost about $196 billion over the next 10 years. I didn't say 196 million. I said 196 billion with a B. More on that in a bit. But essentially what people are looking at is, of those 3 million people that stand to benefit from the Social Security Fairness Act, I would say around 2.1 million are going to get $360 on average. The remaining people stand to collect, and those remaining people are typically spouses and surviving spouses. I call those widows and widowers. They should pick up anywhere between $700 and $1,190 per month. That's more than $1,000 per month. That is significant. That is an absolute game changer. So here's the bottom line. If you're wondering about the Social Security Fairness Act, if you are a retired educator in Illinois, retired public service worker in Illinois, you have a pension that you accrued. That's a non-covered pension because you weren't paying into Social Security while you worked and accrued that pension, then this is affecting you in a fantastic way, but you need to make sure you plan around it, because what this is doing is it's changing Social Security claiming strategies, not just for people with non-covered pensions, but for their spouses. Absolutely, because this thing is all about survivors' benefits, spousal benefits, and we've got information that you need to know. So if you want to learn more, I encourage you to reach out with a phone call, 833-964-PLAN. That's 833-964-PLAN. I actually come from a long line of retired educators. I just happen to be in the financial education business, but we'll walk through what this means for you and what you can and should consider. For anyone who's thinking about claiming Social Security as a part of their retirement plan, your retirement plan needs to be modified now if you have a non-covered pension to make the right choices. So get your Social Security claiming strategy as well. Get retired, stayretired.com. Now, that was great news for 3 million people. What about the other 330 million people in the United States of America? Well, anytime we spend more money, that spending of more money might be a little inflationary. Anytime we spend more money, 196 billion over 10 years, guess what? It might just cause this thing called the Social Security Trust Fund to run dry a little bit sooner. In fact, the CBO, not me, Craig Bolanos, the CBO, the Congressional Budget Office, they have publicized that this event, the Social Security Fairness Act signed into law by President Biden, will cause Social Security to run out of funds and not meet its full obligations 6 months earlier than its original projected date. That's just mathematics, folks. You can't get around it. So what's happening? The ticking time bomb of Social Security is coming soon. I think the entirety of the 2028, more likely the 2032 election cycle, will be about nothing more than Medicare or Social Security. And all this law did was further increase its demise. So what are you doing to protect yourself from the threat of increased taxation that is surely going to come to preserve Social Security? I mean, does anyone really think that the retired voting bloc is going to allow for cuts in Social Security? No possible way. It's all going to be about a revenue raise. And if it's a revenue raise, that means everyone's about to pay more in income taxes. So what should you be thinking about relative to income taxes? Well, time and time again, we talk that people's IRAs and 401ks are just ticking tax time bombs. And I know that sounds dramatic, that your IRA or 401k is a ticking tax time bomb, but to a certain degree, it can be. I mean, don't get me wrong. It's important to have long-term savings, and you need to have all the different types of accounts. You need to have tax-deferred accounts. You need to have tax-free accounts. You need to have taxable accounts, because tax diversification is a priority. But if you're coming into the year wondering whether you should be doing deductible retirement plans, Roth-based retirement plans. Wake up, America. Starting 2 years ago, we had more people scheduled to retire over 11 years. Starting 2 years ago, we were scheduled to have more people in America retire over the next 11 years than had retired in the entire history of America. Wow. You want to talk about an age wave demographic problem? Yeah, the graying of America, the wiping out of America's workforce. That's what's going on. And if you don't have all those people contributing into Social Security, we already figured out how we're going to make up for the gap of intellectual property that all these retirees have. Artificial intelligence, generative AI arrived just in time, but we're not going to have nearly enough workers because of the AI displacement. And that means those who are working are going to put a piano, which is Social Security and Medicare, on their backs and pay a tremendous amount of taxation. And the other people who are going to pay it are those who are perceived to be wealthy. And I got bad news. Just because you don't live in a McMansion and just because you don't drive a Lambo or whatever the cool cars are these days, heck, I got a Chevy Silverado. My American country music sounds a lot better coming through the truck window. But my point of this is a lot of people are going to be asked to pay a lot more in taxes. And you better make sure that you are tax diversified moving forward over the next decade, or your financial models are completely broken. We can help you with that because we've been talking about this on this same very station since 2013. It's been 12 years. And for people who have listened and all the families we have helped throughout Chicago, central Wisconsin, going out to Indiana, I am proud that our strategies that are TNT, test in the trenches, have helped create peace of mind and tax certainty, eliminating that tax time bomb. And we want to help you too. 833-964-PLAN. That's 833-964-PLAN. Go to our website, getretiredstayretired.com. More to come. Craig Bolanos, In the Know.
Get ready to be blown away with a hefty gust of more financial know-how, because we're back with In the Know Radio with Craig Bolanos.
Well, I think everybody knows by now that Wall Street has high hopes for strong earnings in 2025. But I want to remind everybody, for as much enthusiasm as there is, and I'm an enthusiastic person, I say time and time again, several TV appearances this week, other media outlets, I talk about the so-called soft landing. You know what? Why are we calling it the so-called soft landing? It is a so-called soft landing. Wait, pinch myself for just a moment. Did I just see what everybody else saw? Producer prices, which is the cost of the people who make the goods and services, finally went down. Got that data this week. Anybody see that the CPI data, the consumer prices that you and I pay, finally went down this week? Did anybody see that the most important component, which is the year over year change in shelter, that means housing cost, ticked down? Now, don't get me wrong. I'm still raging mad just like you are over how expensive everything is, but at least it appears to be still going the right way. But with all that enthusiasm, I think everybody needs to understand what we're up against and also what we have going for us. So let me remind you of this. When we're talking about getting retired and staying retired, part of that is the safety of principal. It's paramount. Part of that is the generation of portfolio income, interest, dividends, distribution payments, annuity payments to make sure you cash flow your retirement from your earnings. Part number 3 is growing your capital base over time, so that you can grow your income, which in turn allows you to outpace what? Inflation. So what are the tailwinds going in? Boy, you've got earnings growth that could be 12 to 14% year over year. You got profit margins that remain near record highs. Just check out the bank earnings from JP Diamond and the rest of the banks this past week. And you got broader earning contributions this year so far from stocks that are outside the Magnificent Seven or the Elite Eight or the FANG stocks. Here's the bad news. You got some headwinds too. If no one's talking about it, I'm going to. Does anybody realize that after back-to-back double-digit increases in the S&P, we're trading at high valuations? Has anybody besides me noticed that mortgage rates are really expensive? Not by history, but by the recent history of the last 15 years. And is anybody else realizing, especially as I watch all the political appointees get grilled in front of Congress, in some cases unfairly, that fiscal and monetary policy, there's some uncertainty going forward. So here's the thing I'm thinking about. Number one, where do you want to be invested? And if we're following earnings, well, healthcare, technology, they should be up if the analysts are right. Those earnings per share growth could be as high as 20. Industrials, materials, their earnings per share growth could be in the 17 to 19% variety. And then you get the communication services area, consumer discretionary, coming in at 10 to 14% at best. But the major issue that's out here is this whole post-election vibe. Will the tariff and taxes replace the election uncertainty as the dominating force and headline in the months to come? And right now, the market appears to think that the tariffs are all talk and not actual tariffs. What if they're wrong? The tax reform, tariffs could be a downside risk, but tax reform, that's an upside risk. No doubt about it, because this administration, pro-business, deregulatory, getting rid of the bureaucratic red tape, not slowing things down. Where do the interest rates sit? How is consumer confidence? And don't forget something that's crazy. Europe is still on sale. I'm not just talking about the stock market. Has anyone seen that the US dollar has rallied nearly 10% since the end of September? Yeah, let me say that again. The US dollar has rallied nearly 10%. So if you're a US consumer and you're buying a whole bunch of goods and services that's probably crap because it's made overseas, I got good news. It's cheaper than it used to be because the dollar has appreciated. But the strength in that dollar should be discussed by your investment advisor, because if your investment advisors don't talk about currency or your investment advisors don't understand Forex and currency, then you could be blowing in the wind, because a 10% rally in the dollar, guess what that does to people who have chosen to allocate 20, 30, 40% of their money internationally? It's not working. Because when you make the profits overseas and translate them back to a strong dollar, it's a bad place. I think here's my summary on this whole thing. Are Wall Street analysts going to be correct in 2025? Maybe. Good heavens. We all hope so. But what if they are not? And that is why I think people should be using strategies right now, while this market is right near all-time highs, to make excellent decisions to prepare from the future. And we're going to talk about what some of those strategies are. That's what's on deck next. But here's what I think. If you're ready for a family office experience, that's where you can come to one firm and get your investment advice under a fiduciary standard. You can get help with your taxes, your estate plan, your retiree health care. You have the opportunity to get multiple professionals all in the same conference room, all on the same phone call, all on the same video screen, to actually proactively collaborate about the uniqueness of your situation. That's where proactive strategies come from, because no one can be an expert in everything. That's why it takes a team approach, a family office, and that's what we've always done, and we do it so well at VestGen Wealth Partners. Why did I co-found that firm? Because we had a vision of bringing that family office experience to everyone who needs and deserves it. Because the traditional model of mainstream financial advice, it's not invigorating. It is still a sales culture. I see it. Heck, I hear it. You got people pushing products, annuities every day of the week. Nothing wrong with them, but it's not the only solution. You got people pushing trusts. When did selling trusts and selling estate plans on the air actually become a real thing? No, a trust is a mechanism through which you message. You got Joe Namath and the rest of them. God, they were awesome on the gridiron, but pushing people into Medicare Advantage plans, the advantage of an Advantage plan is wonderful if you fit the bill. But for everybody else, you need to look carefully under the hood at what you sign up for so you don't get caught. And I just stand against this conflicted, biased sales culture. We stand against that because you should work with people, work with professionals who come to the office every day, not just out of this passion for hard work, this doctrination of always putting the client's interest first, but it's really about creating a peace of mind experience. Because when people can sleep at night, they can worry less, live more, and pursue everything that matters to them. It's meaningful purpose, but you got to be financially secure. And when you're financially secure, you can pour into these relationships and achieve what we all want. And I think what we all want is our own definition of true wealth. And for a lot of us, the definition of true wealth might just be everything that money couldn't buy and death can't take away. And you know sometimes how that's fostered? Through experiences, the art of the dinner conversation, meals and entertainment, travel, etc. You got to be financially secure. And if you're ready for that next step, connect with us. GetRetiredStayRetired.com. GetRetiredStayRetired.com. Call us 833-964-PLAN. 833-964-PLAN. And we will roll out the red carpet. And especially for those, if you're listening to 560, The Answer, you listen to it because you're like me. I've been on AM radio since gosh knows when, because we'd always run it in the background, because we wanted to be informed, because we wanted to be a good citizen. Because a good citizen is informed and empowered to make great decisions for the collective of this country. And I think we've got some hope. We've got some rejuvenation. We have someone who's going out with a low approval rating, someone who's coming in with a mandate, votes, and the opportunity to really make this economy hum if we have intelligent fiscal and monetary policies and a geopolitical world that starts to heal itself. And that could help the backdrop of this Goldilocks era that we're in, where things aren't too hot, they're not too cold, they're just about right. But even though that sounds like a recipe for a fantastic souffle, or for me, a nice deep dish pizza, I think it's important that you have things in your portfolio that can allow you to participate in markets, generate the income you need, and have some of the hedges just in case it doesn't work out. And that's what we're going to talk about in our next piece. So stick around. There's a lot more to come. You're listening to Craig Bolanos, In the Know, VestGen Wealth Partners, your favorite station. It's the station that's got all the answers. You know the call sign. AM 560, The Answer.
Windy City, get ready to be blown away with a hefty gust of more financial know-how, because we're back with In the Know Radio with Craig Bolanos.
All right, it's that time that if you're not doing portfolio rebalancing, you're doing yourself an absolute disservice. What am I talking about? What is the mix of at-risk investments that you should have paired with your safe money, right? I'm talking about stocks versus bonds, stocks versus treasuries, stocks versus other forms of alternative investments, things that can zig when other things zag. And let's make it simple. You know, someone may have had a balanced portfolio that was 55% in stock, 45% in bonds going back to January 1 of 2023. That same portfolio today is going to be closer to 75 to 80% in stock, 25 to 20% in bonds. And if your retirement plan that's TNT, tested in the trenches, requires you to have a path forward of less volatility, less standard deviation, what are you doing to harvest some of those paper profits and equities and turn them into real dollars so that you can adhere to the tested financial plan that you have? So portfolio rebalancing is number one. But remember, you shouldn't work with a firm that's simply doing portfolio rebalancing on a quarterly basis. I mean, who rebalances with a calendar? That's insane. You shouldn't rebalance with a calendar. You need to be rebalancing based on tolerances, meaning your asset allocation and each of the subcomponents of it. Once it grows too much, there should be a disciplined methodology to rebalance, aka sell into strength, to buy into weakness when the ratios get out of whack, not just because you end a calendar quarter or you end a year. In addition to that, if your single largest expense is taxes, then you need to make sure that your investment advisors are doing true TLO, tax lot optimization, to make sure that they're minimizing the footprint of your capital gains on your 1040. And then part number 3, people should be rebalancing their portfolio by asset location, holding the right types of securities in the right types of accounts to have a known outcome. And if you worry that that level of care isn't occurring for you, there's a whole other world out there. 833-964-PLAN, 833-964-PLAN. Go to our website, getretired.stay-retired.com. Now, one of the things you can be doing if you get a little nervous and you want to lock in some of the gains, but you're not ready to commit to individual bonds, defined maturity bond ETFs, maybe what you do is you start building in some buffers. We've called them cap and cushion. And this is a distinctive framework where there are products out there now that are viable, that are liquid, that allow someone to capture the gains of large cap US equities to a cap while providing up to 100% downside protection prior to fees and expenses over the outcome period. The outcome period being 6 months to a year to 2 years. So when you invest in these cap and cushion strategies, what I call buffered ETFs, it's providing a combination of growth potential and capital preservation when you hold the cap and cushion over the outcome period, which again is going to be 6 months, 12 months, 2 years. And this compelling combination, it's not just fueled interest, it's fueled a lot of growth in the asset class. And what that's doing is it's lowering expenses, lowering minimums, making them accessible to everybody. And that's a great place to be. So what you do is you start by determining the best buffer ETF or cap and cushion for your investment goals. Is it short-term and myopic, getting through the next 6 months? Is it going out 12 months? Is it going out 2 years? But notice, we're not talking about making commitments to an annuity contract that's tying you up for 10, 12, 15 years. No, we're talking about keeping it simple, making a short-term commitment of time where you can participate in large cap US equities to a cap with a downside buffer. Somebody might say, hey, what else do I want to know? There's tax alpha in these. Yes, tax alpha. Alpha is important. Taxes are important. And what I mean is these cap and cushion ETFs have a structural advantage, which is an ETF wrapper. And remember, exchange traded funds have these natural tax efficiencies that are inherent to the process. That's a heck of a lot better than owning an investment that is taxed at last in, first out, or an investment that's taxed at ordinary gains. And the best part is These are just liquid. They're easy to put in. So strategy number 2, besides your normal rebalancing, is maybe it's time that you learn more about the concept of cap and cushion, which is investing in dirt cheap, low cost, tax efficient ETFs with outcome periods of 6 months, 12 months to no more than 2 years. So you can participate in the upside of the market with 100% downside protection, assuming you hold the security for 6 months, 12 months to no more than 2 years. If you want to learn more, you can. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Idea number 3, besides the typical rebalancing for tolerance, tax lot optimization, looking at cap and cushion strategies for your portfolio. The third avenue that's there is, I talk about it time and time again, it's a focus on income. And after all, the 3 pillars of retirement income we use, pillar number 2 is about generating sufficient portfolio income to cover your spend. And that, when I think about income, if you qualify participating in the world of what I deem to be private credit, can be an absolutely fantastic place to be. It is all about the income. And you've got annual distribution rates ranging from 8.4 to 9.3% in the environment for those who qualify in the world of private credit. That's the ability to be a lender, the ability to work with some of the top private equity firms out there who are doing what I deem to call portfolio lending. And they're doing it in such a way that they are senior and oftentimes collateralized in the debt structure, aka a first lien position. And that's not taking all of the risk out, but what it's doing is it's putting people in a position to capture income and distribution yields larger than that through which they can accomplish with traditional bond investing. So I think 2025 becomes the year with increased VIX, a soft landing, but the acknowledgement of the equity risk premium that's there, the fragility of some of what's happening in the world. It's a great time to rebalance back to tolerance and incorporate different strategies. And I think private credit, portfolio lending is an excellent solution, whether it's done on an interval fund basis, a business development company basis. There's different ways to access those products, and we are a conduit for people to get empowered with education to do such. Again, not everyone qualifies, but for the right people, it can absolutely be the right solution. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. We exist to provide a family office experience to everybody, an integrated approach where you have multi-disciplined professionals, the taxes, the estate, the investment, the financial planning, the retiree healthcare, all modeled under one roof. And that creates that experience of a family office. It's time to reinstill faith and confidence with everybody who lost trust in that traditional model of financial advice. That's a sales culture. Let's put you in a position to start winning by have you have your interests first.
Windy City, get ready to be blown away with a hefty gust of more financial know-how, because we're back with In the Know Radio with Craig Bolanos.
So in that last segment, we spent time talking about what it means to take high equity premium valuations, convert them into safer money strategies by rebalancing your portfolio using strong protocols and tax lot optimization. That led into a discussion then about how that's done. We talked about rebalancing into fixed income. We talked about rebalancing into the world of what I call cap and cushion. Those are buffered ETFs where you participate in large cap US equities to a cap with no downside loss of principal when held to the term, 6 months, 12 months, 2 years. We also talked about the world of portfolio lending, private lending, private credit, and the ability to access, for those who qualify, solutions that can get you primarily into a portfolio that's first lien position, oftentimes senior and secured, with distribution amounts that have historically run in the 8 to 9+% rates of return each year per year as a way to enhance traditional bond investing. The next thing that I think about is this. No one's excited about real estate, but maybe it's time to start focusing on other parts of the real estate market. One of the things we have to look at is, I was reminded this week, I saw PPI come down, producer price index. I saw CPI, consumer prices, come down. That's good news. And if that's good news, maybe the Fed, who is going to be on pause still in January and in March, maybe they do get back to the rate cutting path in the second half of 2025. First opportunities from my vantage point is maybe July or September, but cuts in borrowing cost would be good for private credit. Cuts in cost would be good for real estate. And one of the areas I think people got to be excited about in the world of real estate remains industrial real estate. And a big part of industrial real estate that I think's about is, having a portfolio of high quality, bulk, and last mile distribution facilities in key logistic markets. Let me say that again. Building a portfolio that invests in high quality bulk and last mile distribution facilities in key logistics market. Now, what am I talking about? You know what these things look like already. They're big concrete bunkers that have dozens and dozens of gigantic truck doors in them. And what's happening? Everything that comes to your door in corrugated cardboard, think Amazon, your Walmart deliveries, you name it, everything's coming from those logistic distribution centers, courtesy of intermodal, which is trucking. Right? And we got lots of it in Illinois. But when you can invest in projects like that, isn't that where the world is going? Omnichannel is what it's all about if you're a retailer. It's the in-store experience combined with the online experience, combined with this and that. But I know for me and my family, I resisted foolishly years ago, everything being delivered to my door. And now the fact that I can sit up, feet on the couch, watch playoff football and order the stuff I need, and it literally lands same day, next day, no later than the next day thereafter. Man, that's terrific. And there's obvious ways to invest in equities, publicly traded securities of those companies who use that. But why not invest in the actual brick and mortar? What's wrong with starting to get assets that aren't just publicly traded, but assets that are non-publicly traded, less correlated to the speculative ups and downs of the stock market? And I think finding a way into some good industrial real estate investment trusts that can again focus on those high quality bulk and last mile distribution facilities across the key logistic markets just makes a lot of sense. And these are not get wealthy strategies. These are stay wealthy strategies. That's what we've been talking about today. We've been talking about just taking some of the equity risk premium and transferring it into other places to further diversify one's portfolio, because the truth is, diversification is the only free lunch when it comes to investing. Now, earlier today, I said, hey, there's going to be a new administration coming in. And what's going to happen? Let's talk about it. I think right out of the gate, no matter what, number one, the administration's going to focus on extending the provisions of the gigantic, ginormous, boisterous 2017 Tax Cut and Jobs Act. That was the most sweeping tax reform that we had seen in some 36 years, okay? And I think that's the first thing that's going to come through. They're going to make a play to make the individual Tax Cut and Jobs Act permanent Permanent, not do this budget scoring stuff where it expires in 2025, which is what they did in 2017. I think they're going to make a play to actually make this thing permanent. So what are the pros? Well, if the pros are everyone saves money under the TCJA, just know that you're probably not going to be going back to itemizing anytime soon. That was one of the, intended effects, I think, of the Tax Cut and Jobs Act. The negative of this, of course, is, hey, depending on economic growth in the U.S., it could exacerbate the federal deficit, which we all know is a problem. We all know it's a problem. So it's a balancing act. Number two, what could we see? We could see lower corporate tax rates. They already came down under the TCJA, but you could see them go down to 20. Some people say as much as 15. Now, would that be accretive? Oh, of course it would. But, people would argue it's going to benefit certain people because not everybody has a lot of investment wealth. Next, we've heard about them time and time again. The universal 20% tariff on imports, 60% on Chinese imports. And the argument here is that tariffs might protect American jobs by encouraging onshoring. That means more domestic production. The counterpoint to it, of course, is it's going to increase prices. But if you have a strong U.S. dollar and they're done with intelligence, maybe it wouldn't be devastating. We'll find out. I've also heard rumors, as have you, just go hang on the internet, that they're talking about trying to provide some relief for exempt overtime pay and tips from federal tax. Now that would be huge, but I got to tell you, that could be subject to abuse by employers, might not actually help those who were intended. It's definitively a federal revenue loss. I don't know that that's going to happen. I've heard about ending taxes on Social Security. Oh, what a relief that would be. What a relief that would be. But it would disproportionately benefit higher income earners, further hasten the trust fund insolvency, which we talked about today, courtesy of the recently passed Social Security Fairness Act. So I think that's going to be pretty tough. What about this? There's something in the Tax Cut and Jobs Act that grew estate tax exemptions. And there's a push to maybe make that permanent. And there's a lot more people who understand that. I mean, I'm not going to do a total spoiler, but think about how big estate taxes played into that show Yellowstone with Kevin Costner that everybody looked at. That's right. I've also seen discussion about raising or maybe just outright ending the SALT deduction cap. Oh yeah, that's a massive PETA. You know what a PETA stands for. I mean, the SALT cap right now means your state and local taxes, they're capped at 10 grand. Oh my gosh, that's your real estate taxes. That's all the taxes you pay on your wages. Lots of people have 12, 15, 18, 22, 50. I mean, lots of people are mad about the cap on state and local taxes. I think that's something that they are going to do. And I do think they are definitively going to eliminate some of these clean energy tax incentives. What's the bottom line? My job, our firm's job, a family office for everybody, is to make sure we stay ahead, understand what could be coming down the pipe, and help you navigate these waters. I mean, for everybody who was subject to the SALT cap workaround, if you're a pass-through business entity, we've been doing the pass-through entity tax for everybody since it first became available in Illinois. Shame on you if you're missing it. We talk about this stuff. And if you value that level of proactive advice and communication, call us, 833-964-PLAN. Go out to our website, getretired.stay-retired.com.
Hey, Windy City, get ready to be blown away with a hefty gust of more financial know-how, because we're back with In the Know Radio with Craig Bolanos.
It's about getting retired. It's about staying retired. It's not about surviving in retirement. You want to thrive in retirement. And that's going to take a commitment to a system. I call it the 3 pillars of retirement income. Number 1 is once you're on the cusp of or already retired, we have to accept that everything we have is pretty much everything we're going to ever have, and safety of principle becomes paramount. That does not mean you don't invest to grow your capital balance, but it means you need to deploy strategies that aren't just passive. They need to be a combination of passive and active to navigate a market and an environment that moves faster than it's ever moved. Markets are still markets. People are still people. But remember, the markets, the exchanges have changed ever since the introduction of algos and algorithmic-based trading. Part number 2, you got to generate sufficient income to cover the monthly spend. That's interest, that's dividends, that's distribution payments. And you know what? We're in an environment where interest rates are high to where they've been. It is the single best time to be locking in coupons, locking in yields now, so you can just cash flow your retirement and have the freedom from worry for the next 7 to 12 years. That's where you position on the yield curve in a barbell strategy. Part number 3, you got to find a way to grow that capital balance over time so you can grow your income over time, so you can outrace your Cook County property taxes. You can outrace the silent killer, which is inflation. And you got to bring all of this together. And at VestGen Wealth Partners, we are delivering a family office for everyone. Our goal is to reinstill faith and trust and confidence with everyone who's lost trust in the traditional model of mainstream advice, because it takes a team approach. It's not a solo advisor with an assistant. It is a team approach, because money never sleeps, markets never close, and economic things are a constant change, just like the arc of life is incredibly dynamic. And if you want to work with a fiduciary who has multiple disciplines all under one roof, representing a shared client base, connect with us. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Call us 833-964-PLAN, 833-964-PLAN. My name is Craig Bolanos, co-founder, wealth advisor, VestGen Wealth Partners. We want you to get retired and stay retired. We look forward to partnering with your family and helping you achieve the freedom from worry so you can live more, worry less, and pursue the passions that are true to you.